Hey, I had to just jump in here really quickly because it turns out everyone was wrong in their 2023 predictions. Or everyone was right? I mean, actually, most were right initially, but now they're wrong. And the few that were wrong initially, now they're right.
I'm confused.
For now, the real estate market of 2023, it's just flat out weird.
Weird. Very weird.
Most housing analysts expected 2023 to be a really rough year for the US housing market. In fact, among the 29 major housing forecast models, 24 forecasted a national home price decline for 2023. And then, right out the gate this year, it was clear that the US housing market, which saw a historic decline in home sales in the second half of 2022, was no longer in freefall mode. The crash of all crashes, in hindsight, looks to be nothing but a fender bender. The market stabilized around January through a combination of improved buyer confidence, tight supply, and a slight decline in home prices and mortgage rates doing just enough to improve affordability. Now, fast forward through April, and it's looking like the housing market hasn't just stabilized, it might be returning to growth mode, predicts the real estate research firm CoreLogic. After 7 consecutive months of home price declines, the CoreLogic Home Price Index detected a 0.8% home price uptick in February. 2022 saw the US housing market slip into the first price correction since the housing bust bottomed out 11 years ago. The correction was particularly sharp in markets like Phoenix and Seattle that saw home prices fall 10% and 16% respectively from their peak. In the eastern half of the country, the correction is much milder as some regional housing markets, including Cleveland, didn't see prices pull back even 1%. The correction seems to have all but lost its steam. Home prices are still high, and while there's been a slight decrease in demand, albeit an artificial one due to interest rates, it hasn't been enough to significantly impact prices. In fact, existing and new home sales have inched up a bit this year, and home builder confidence has improved, and firms like Zillow, CoreLogic, and Black Knight have all reported positive month-over-month home price increases this spring. So, what's going on? I mean, aren't we headed for a recession? I mean, if we're not in one already, well, here's the deal so far. Housing affordability has improved this spring as the average 30-year fixed mortgage rate, which topped out at 7.3% in November, came back down to around 6.5%. Additionally, a lack of homes for sale, coupled with the market entering its busier spring period, has at least for now pushed the national housing market back into equilibrium. That said, under the hood, the housing market isn't exactly normal just yet. Some housing markets are booming right now, like Jackson, Tennessee and Scranton, Pennsylvania, while other places like San Jose, Austin, and Las Vegas are still experiencing a home price correction. And even within a particular market, it can vary quite a bit. We know that the imbalance of supply and demand in the housing market is poised for long-term growth, but it's the short term where the uncertainty lies. And the American people are sitting on pins and needles concerned about their financial futures, waiting to see the Fed's next move. I mean, what are your thoughts about making important investment decisions based almost exclusively on the seemingly illogical decisions of your government? Let me know in the comments. I mean, we're talking about a government that year after year demonstrates fiscal incompetence, lacking the most basic of financial competencies like balancing a checkbook. If you think you manage your checkbook better than the government manages theirs, let me know by smashing the like button. All current indicators are pointing to a future not nearly as grim as most predicted. But here's the big variable that could send everything plummeting. History tells us that the Federal Reserve's inflation-fighting playbook starts with the US housing market, and it goes like this. The central bank begins by applying upward pressure on mortgage rates. Soon afterwards, home sales fall and home builders begin to cut back. That causes demand for both commodities like lumber and concrete and durable goods like refrigerators and doors to fall. Those economic contractions then slowly spread throughout the rest of the economy and, in theory, help to rein in runaway inflation. And that's exactly what we saw last year. The Fed started jacking up interest rates, mortgage rates spiked, and the US housing market slipped into an old school housing downturn. And here we are, spring 2023, changing course already. But will this uptick in new home sales be enough to stop the economic headwinds created by the housing slump? Well, since World War II, declines of greater than 10% in the annualized rate of investment in housing construction and improvements have coincided with recession on all but 2 wartime occasions when defense spending propped up the economy. In the last 3 quarters of 2022, declines in such investment hovered around 20%. And that is why most experts are still leaning into their predictions of the US economy slipping into a mild, not deep recession. Yep, not deep. This is not 2008. Even though a recession is likely, the housing recovery will then help to drive the overall economy recovery, like it always has. But it's different this time, is the public sentiment. More famous last words have never been spoken. The U.S. housing activity will be driven in the next couple years by one, the structural undersupply of homes that's prevailed since the 2008 global financial crisis. I mean, there's a decade's worth of building deficit that you just can't ignore. Two, the robust demographic trends. The peak age of the millennials are moving through the average age of the first-time homebuyer, causing over the next few years more demand for housing than ever before in the history of the United States. Not to mention that the millennial sentiment toward homeownership has turned positive. And three, strong borrower fundamentals and high equity cushions. CoreLogic doesn't expect a further dip at all, but rather home values to rise 3% between January of 2023 to January of 2024. And if CoreLogic is right, then U.S. home prices would end 2023 back at price levels achieved at the height of the boom in June 2022. CoreLogic is convinced prices just bottomed out, and we may be in for a period of steady growth. Now, Zillow, not as bullish as CoreLogic, but is still very optimistic that we've bottomed out and is forecasting over 300 markets to mildly rise in values of 1% over the next 12 months. Now, on the other side of that, you've got Mortgage Bankers Association, Goldman Sachs, Fannie Mae, and Moody's all in agreement that we have further to pull back before we head up again. But if we look at this chart that shows the disparity between the bulls and the bears, there's not that much of a gap between the two. What is undeniable, real estate is reverting to its time-honored adage, location, location, location. According to Zillow's data, cities like Phoenix, Las Vegas, and Atlanta are expected to see significant growth in the coming years. These cities have a strong job market, a growing population, and plenty of affordable housing options. In other locations, some cities are expected to see a decrease in home prices, including San Francisco, New York City, and Los Angeles. These cities have become prohibitively expensive for many people, and it's likely that the market will correct itself to some extent in the coming years. But the supply and demand factor is so lopsided in favor of the demand that nobody is predicting a housing crash. And here's what I mean. As of the recording of this video, inventory is finally climbing for the spring season. The market saw the most new listings in a week since September, with 80,000 single-family homes on the market. And something you may hear at your next dinner party, yeah, but the housing bubble is about to pop. Who can afford a house at these prices? But 21,000 of those new listings that just hit the market were gobbled up almost immediately, showing that demand is high for new supply, and so is the ability to buy. Further, the percentage of homes on the market that had to lower their price dropped back to 29.4% this week, almost back under the levels of 2019. And the median price of single-family homes this week is up 1% from last week to $441,000. The declines in home prices seem to be behind us, and the market is much healthier than it was late last year. While we still have half as many homes available for sale in the last decade, inventory has been climbing for a couple of months now. And this is important because the price of new listings is a forward-leading indicator of future home sales prices, and the price of new listings reflects the signals of future home sales. And the signals right now are not bad at all. This is because there are fewer home cuts now, meaning that homes on the market are getting offers around their list price. This means that the sales prices in the future are not falling.
That's weird. That's weird.
Hey, the numbers are the numbers, and they don't give a damn how you feel about them. So what is there for you to do now? Well, as long as you're not speculating and trying to time the market in the short term, it'd be really tough to lose with a long-term focus investing in real estate. As they say, don't wait to buy real estate, just buy real estate and wait. But hey, what do I know? I'm just some guy on YouTube. I could be wrong. I mean, the majority of experts sure were. So you might as well chime in and share your expert opinion too, below in the comments. I mean, you couldn't do any worse. And who else do you know that has an expert opinion that needs to see this? When their name comes to mind, please share with them. Thanks for watching. I'll see you next time. Take care.